Hello, good evening, and welcome to part 2 of IAS 16. So the second part, I'm going to deal with the revaluation of the subsequent measurement of an asset of property, plant, and equipment. In the first video, we dealt with the initial recognitions, we dealt with some of the definitions, and we dealt with aspects to do with how you can actually recognize an asset and other definitions. So in this part of the lecture, I'm going to dive straight into the revaluation model, the subsequent measurement of an asset of property, plant, and equipment. With that said, allow me to just share my screen so that we can dive into the lecture itself. All right. Let me put it in slide mode. That's right. Okay, so part 2 of IAS 16 property, plant, and equipment. My name is Kelvin Kapotwe, your tutor and your friend. So let's go direct to subsequent measurements. Let's go to subsequent measurements and deal with this part of the standard. So accounting for revaluation is what we are actually going to look. So we are going to look at the accounting for revaluation under subsequent measurement. All right. Okay. So subsequent measurement. So remember, when we met in the first lecture, I gave you guidance on how you can, recognize an asset at how you can initially recognize an asset after you purchase it. So how do you incorporate that asset in the book? So we learned that initially you're going to incorporate that particular asset at cost, and we learned how to determine that cost. So here now we're going to look at subsequent measurement. How do you then recognize an asset when after you've acquired the asset and then maybe you do something called an evaluation model. So a revaluation model. So IAS 16 has permitted us to say, subsequently, an asset of property, plant, and equipment can be measured by either of the following models. So you can either use the cost model or you can use the revaluation model. So the cost model is actually the simplest, because under the cost model, what you're going to do is you are going to get the cost less any accumulated depreciation and impairment, okay? So under the cost model, what is just required is if you're going to adopt the cost model, then we are saying under this model, the asset of property, plant, and equipment must be carried at the cost less any accumulated depreciation and impairment. I think you know how to calculate depreciation, and I did explain in the last video what an impairment loss and how it comes about. All right. Then if you are going to choose the revaluation model, an asset of property, plant, and equipment must be carried at the revalued amount, less any accumulated depreciation and impairment. So that's the difference there. For the cost model, it's the cost less any accumulated depreciation and any accumulated impairment. But if you are going to adopt the revaluation model, you need to then carry it at the revalued amount less accumulated depreciation and accumulated impairment. Now, when you go with the revaluation model, the standard has provided extra guidance of the things that you must do if you're using this particular model. When you choose the cost model, there must be subsequent, okay, subsequent regularity so that the carrying amount does not deviate significantly from the fair value. Avoid the two there, it's a typo. From the fair value. Okay, so that is the first condition that you must meet. If you are going to go with the revaluation model, then what they are saying is you must be revaluing your asset regularly. The reason is that you don't want to have the carrying amount deviate from the fair value significantly. Okay, so For example, you can decide in your company to say we'll be valuing this class of assets after 1 year. Okay. The reason you're doing that is you want to test what is the actual value. Because remember, IAS 16 requires us to state the asset at its fair value. All right. So you don't want your carrying amount to deviate from your fair value, because then you will be overstating your assets in the financial statement of financial position. So as such, the standard requires us to be revaluing regularly so that there's no deviation from the fair value. That is the first condition that we must meet, and I've explained the implication there. Then the second one, I think I didn't include it there, but the second condition is that when you choose to go with a revaluation model, you must actually revalue all the assets that fall in that particular class. Okay? You must value all the assets that fall in that particular class. The reason is this. If you've got, for example, an asset of a building, for example, you've got a building in Lusaka, you have a building on the Copper Belt, you have a building in Mansa, then you have a building in Isesheke, you've got a building in Chipata. Okay, so these buildings are falling in one class of PPE. All right, so it would be illogical of you to say, okay, let's only value the assets that are in Lusaka and Copper Belt. You know why? Because you know that the economic conditions in Lusaka and Copper Belt, as compared to the other, to the other towns, are different. So when, for example, you value the assets that are just in Lusaka, you expect that the value would have gone up and you would have benefited and restate your numbers. Okay. But you leave the asset that is in Mansa and in Isesheke because you know that there, if we conduct an evaluation, basically you find that even the fair value may even have gone down, or it won't increase significantly. So you wouldn't want to spend time and revalue those. But the standard says you must revalue all the assets in that particular class. So the reason is that in Mansa, if the fair value in Mansa goes down, that revaluation loss or the impairment loss must be accounted for in your books. If in Lusaka, the building that you have as appreciated in the fair value, there is that revaluation surplus, then that revaluation surplus must be accounted for in the book, and we'll learn how to account for revaluation surplus the revaluation gain as we proceed in this lecture. So that's what it means, and those are the conditions that must be met. I've explained that, and I think you've been following me. All right. So now let's look at accounting for valuation. So when you've done a revaluation, this is how you're going to account for a revaluation. Number one is restate asset cost to the new revaluation. So when an asset has been revalued upwards, what you're going to do is you need to go and restate the amount that is in the non-current asset account with the revalued amount. So you replace that amount with the revalued amount, okay? So basically what you need to do is you're not going to get the whole amount 65. For example, if the revaluation amount, the carrying amount is, say, if the carrying amount is, say, 45,000 kwacha in that account, in the asset account, and then when you do a revaluation, you find that actually the fair value of that particular asset is 65,000 kwacha. We are not going to get the whole 65,000 and lump it on that account. No. So what you do is you're going to calculate the gain. 65,000 kwacha minus 45,000 kwacha will give you a 20,000 kwacha difference. So that is the amount that you're going to debit to the asset account. 20,000 be debited to the asset account. Okay? And then the other thing that you need to do, the other thing that you're going to do is that you are going to eliminate any existing accumulated depreciation for that asset. You are going to eliminate any existing accumulated depreciation for that particular asset, okay? And then you are going to calculate depreciation at the revalued amount. So eliminate the old depreciation at that was calculated at cost, and then recalculate depreciation at the revalued amount. Some examples, I think in the second video, in the third video, we'll do a lot of examples so that you can, bless yourself with some of these, tricks. Then, show the total increase in other comprehensive income. So the total increase that we are talking about is the revaluation gain. So the revaluation gain goes to other comprehensive income at the foot of the statement of a profit or loss. So this would be then taken to the revaluation surplus. So remember, so the gain, you are going to show it, you are going to show the gain in other comprehensive income, and then that difference, the gain, you are going to debit it to your asset account so that you align your carrying amount. Okay, you align your carrying amount to the fair value, and then the other leg will now go to the revaluation surplus account in equity. So revaluation gain is actually a component of equity. So that's how you must deal with these things. So those are the entries there. They are saying non-current assets debit. So you debit with you debit it with the valued amount, and then you are going to accumulated depreciation, eliminate or exist. So to eliminate depreciation, you actually debit it. Okay, so to eliminate depreciation, you actually debit it, then you'd have canceled. I think you remember from your financial accounting. And then you are going to send a credit to other comprehensive income and then record it in the other account as revaluation surplus account. All right, so that is about the revaluation gain. So I was talking about the accounting, and then the revaluation. So a revaluation gain is recorded under other comprehensive income in the P&L. I think I talked about that. So you record it in other comprehensive income in the P&L. The revaluation surplus is then credited with revaluation gain in it being a component of equity. Apologies for that. So the revaluation surplus is then credited with the revaluation gain in it being a component of equity. So when you get that evaluation, the revaluation surplus, the revaluation gain, you are going to now credit it to the revaluation. You are going to credit it to the revaluation surplus account. The reason is the revaluation surplus actually is again, and a revaluation surplus is again on a capital asset. So it forms part of owner's equity. So the revaluation gain is a capital reserve. Okay, so now let's get to understand this. A revaluation gain is a capital reserve. As such, it is non-distributable. It is a non-distributable reserve as it relates to gain on a capital good. Why is a revaluation reserve or a revaluation gain not distributable? Look, what you've done is you've got an asset that the shareholder bought, okay? A shareholder bought this particular asset. Now, this asset has gained in value. So what you are just doing is just want to restate the value of the asset. You've not received any cash that should be distributed to the shareholders. So it's basically a gain. You can only come and distribute it when you actually dispose that particular asset. And at the time that you are disposing, you have got something in your revaluation again relating to that particular in your revaluation surplus account relating to that particular asset. Then that cash is going to be realized, and then you can transfer it to retained earnings and then redistribute it to the shareholders. But for as long as that revaluation gain is in the revaluation surplus account and the asset has not been disposed of, you can never distribute it and you can never redistribute it or transfer it to retained earnings. No, it is a capital reserve, and as such, it will just be there in the under equity as a component of equity. All right, so evaluation losses. So I've talked about it again. Now let's talk about revaluation losses. Revaluation loss arise when the carrying amount of an asset exceeds its fair value or when an asset suffers what is called impairment. So a revaluation loss arise when the carrying amount of an asset exceeds its fair value or when an asset suffer what is called impairment. So when an asset is impaired, that asset has there's going to be what is called a revaluation loss. Okay, so if you are revaluing an asset for the first time, so get that, take note of this matrix. If you are revaluing an asset for the first time, you find that its carrying amount exceeds its fair value. So the carrying amount in your books exceed the fair value of this particular asset. So carrying amount is here, fair value is here. This difference is the impairment loss. If you are revaluing it for the first time, you should not create a revaluation surplus account. If you are revaluing it for the first time, and the first time that you revalue an asset, you actually realize that there is a revaluation loss, you should not create a revaluation surplus account. Because there's no, you don't, the standard doesn't permit you. So what you are going to do then is this. You are going to credit the asset account with the loss, the revaluation loss. Okay, you are going to debit the asset, you are going to reduce the value of that particular asset by crediting it. And then you are going to credit that impairment loss to the P&L. Then you would have met your double entry. So the double entry system would have, been met, and the accounting equation is going to balance. So those are the things that you must do. If you are revaluing the asset for the first time and you find that its carrying amount exceeds its fair value, then the difference between the two must be charged to the P&L. That is called an impairment loss. And the other leg will be a credit in the asset account to reduce the value of that particular account or to restate it to its fair value. When a revaluation loss arises on a previously revalued asset, it must be deducted first against the previous gain and then taken to other comprehensive income in the year. Another trick. So now we carry an evaluation or a revaluation on a particular asset. Okay. We carry a revaluation for the first time on a particular asset, and then we realize that, okay, the fair value actually exceeds the carrying amount of the asset. So this is the carrying amount, and then this is the fair value. So this difference is what we are calling the revaluation gain. The revaluation gain, because the carrying amount is lower than the fair value. So our asset has appreciated in value, hence creating that revaluation gain. So at that point now, you are going to create what is called a revaluation surplus account. Okay, so you are going to create a revaluation surplus account, which you are going to credit. Why am I crediting the revaluation as surplus account? It is a component of equity, and to increase equity, you credit the equity account. To reduce an asset, you credit, and then to reduce equity, you debit. And then to increase an asset, you debit. So those are some of the things that you need to acquaint yourself with. So I'm going to credit the revaluation surplus account with the revaluation gain. Okay? And then the debit is going to go in the asset account to restate it to its fair value. And then we are going to record the gain now in under other comprehensive income. Okay, so that's how you must actually account for it. Now, if the second year that we are doing a revaluation, if the second year we are doing a revaluation, we discover that again, the value of the asset, the carrying amount of the asset exceeds the fair value. So we create that revaluation loss. Okay, we create that revaluation loss. So then what we are going to do is, okay, what we are going to do is we are saying it must be deducted first against the previous gain. So go to the revaluation surplus account and do what? Debit it with that loss. When you debit it with that loss, the revaluation account, and then you are going to do what? to also less the value of that particular asset. And then the loss deduct against the previous gain, and then take the other other comprehensive income. So that's how you should deal with those two scenarios. So different scenarios, pay attention to the question and understand the question. What does it need me to do? And what happened here? So those are some of the questions that you should be asking yourself as you are looking at exam questions and other questions to do with revaluation surplus. Then we are saying any excess impairment loss will be charged as an impairment expense in the P&L. It will be charged an expense loss in the P&L. So in an event that at the second revaluation, the revaluation loss exceeds the revaluation gain that was in the revaluation surplus, you are going to create an excess loss. So that excess impairment loss should now be charged to the P&L. Okay. Then we can talk about reversal of an impairment loss. So remember, we talked of a scenario where we revalued an asset in the first year of acquisition. I mean, for the first time, we revalued an asset for the first time. And then when we revalued that asset, we realized there was a loss that was made. Remember, I talked about not creating a revaluation surplus account, but just get that loss and, hammer it, charge it to the P&L as an impairment loss, and then reduce the asset account there. That's what I said. But now what happens if in the second year that we revalue an asset, we actually realize that there's a revaluation gain, okay? There's a revaluation gain. What then must we do? The standard permits us to do a reversal of an impairment loss. When an asset is first revalued and we realize that it has suffered impairment, we can credit the asset account with the loss that was recorded. Okay, we can you credit the account with the loss and debit the P&L. That is a record of impairment the first time. Okay, that is a record of impairment the first. Follow me closely. Sorry, don't want to confuse things here. That is the first time that we revalue. Now, subsequently, when we perform a revaluation and we realize a revaluation gain, it is a sin. It is a sin against the standard to credit the whole amount, the revaluation surplus account. Again, let me repeat this. Subsequently, when we perform a revaluation and we realize a revaluation gain, it is a sin against the standard to credit the whole amount, the revaluation surplus account. Something must be done. And what must be done is this. So the standard requires us to reverse the impairment loss that was recorded in the first point. Okay, that impairment loss that are recorded in the first point, we are permitted to reverse that impairment loss previously suffered by crediting the P&L. So you're going to credit the P&L. When you credit the P&L, you're crediting profits, okay? Profit is a component of equity as well. So to increase equity, you credit it. So you're going to credit the P&L with the loss suffered in the first point there. Then the balance be credited to revaluation reserve, okay? Then the balance be not be credited. So the balance is going to be debited to the revaluation reserve. Sorry, it's a typo there. I have to change. So that balance will have to be the balance. So let me use an example. I'm confusing myself here. So if there's a revaluation, so if, for example, we recorded a 5,000 impairment loss, which we posted to the P&L, okay? What we are going to do is we are going to credit the P&L to cancel that loss, and then we are going to debit which account? We are going to credit the revaluation account with the difference that we get, okay? So we are going to debit the asset account with a difference. So if for example, the loss was 5,000 and our revaluation gain was 20,000. So what I'm saying is we are going to credit the 5,000 credit to the P&L, okay? And then debit the 15,000. Debit the 15,000 in the asset account, okay? Debit the 15,000 in the revaluation account. We are going to debit the revaluation account with 15,000 kwacha, okay? So we'll credit the revaluation account. It's correct. We'll credit the revaluation account with 15,000 kwacha, okay? When we credit the revaluation with 15,000 kwacha, remember the revaluation was how much? There was that loss that was in the account. We are going now to credit the asset account, all right, to try and restate those two things. I think that's how you must do it. And then they again debit it to the asset account. Okay. All right. I think that's how it's supposed to be done. The standard requires us to reverse the impairment loss previously suffered by crediting the P&L with the loss. Okay, you credit the P&L with the loss and credit equity. Okay, you credit equity with the 5,000. You reduce the revaluation surplus, and then you credit. You are going to debit the asset account. Sorry, so you're going to debit the asset account with the revalued amount, and then credit the P&L with the 5,000, and then you're going to credit the balance to the revaluation surplus account. So that is the correct treatment when you are doing a reversal of an impairment loss. Forgive me on to touch upon and kind of, I think trying to transfer a point, but that's how you must actually account for this particular transaction. So those are the journal entries there. Okay, so the journal entries will actually help you correct the position. So revaluation gain. When there's a revaluation gain, you debit a non-current asset and credit the revaluation surplus. Okay, a non-current asset is an asset, so the asset side of the equation must balance with the credit side. So on the credit side, you've got capital plus liabilities. Remember, capital is a liability because the owner's equity actually is the money that the owners have put in the business. As such, we consider it as a liability to the business. Okay, so debit, asset, credit, revaluation, surplus. Revaluation loss, where revaluation surplus account exists. So where the revaluation surplus account exists, what you're going to do is just credit non-current asset if there's a loss, credit non-current asset to reduce or restate the value, and then debit revaluation surplus to also reduce that loss from there. Then revaluation loss at first revaluation. So if you are revaluing the asset for the first time, those are your entries. They are credit non-current asset and debit P&L if you have a loss there. And then reversal of impairment is debit non-current asset, credit P&L, and credit revaluation surplus with that 5,000 or the difference, I mean the loss that was posted to the P&L initially. Okay, so once you do that, your equation should actually balance. Now let's look at depreciation of a revalued asset. Okay, once an asset has been revalued, the following treatment is required. Depreciation must be charged based on the valuation on the valuation less residual value over the remaining useful life. So when you revalue an asset, you must actually calculate depreciation at the revalued amount, and that's how you are going to calculate the depreciation charge. Then the all charge must go to the statement of profit or loss for the year as an expense. So that is the depreciation charge that you've calculated at the revalued amount is what you are going to charge to the P&L as a depreciation expense for that particular year. Then the whole charge must go to the statement. When you calculate depreciation on the revalued amount, you will realize that the depreciation charge will be higher than the previously calculated at cost, resulting in excess depreciation. Because if, for example, you revalue an asset higher, you would find that even when you calculate depreciation at a higher amount, you are actually going to realize that the depreciation charge will be higher than that one which was calculated at cost. Okay? As such, the standard permits a reserve transfer to deal with the imbalance between the non-distributable reserve gain held in the revaluation surplus and the reduction in retained earnings due to the increase in depreciation. So what this means is the fact that you've revalued the asset, you have restated depreciation. Remember, depreciation is posted to the P&L as what? As an expense. So this unfair calculated depreciation, because of the value in the asset, this value that has been created in the asset has actually caused depreciation to go up. And depreciation actually affects distributable reserves. The distributable reserves we're talking about here is the retained earnings. So when I charge it to the P&L, I'm reducing the retained earnings for the shareholder. So it is actually unfair. Okay, it is actually unfair. So what we are going to do is we must do what we call a reserve transfer. Okay, you must do what we call a reserve transfer. This depreciation is supposed to be charged to non-distributable accounts. So it's charged to the P&L, but under normal accounting circumstances, this one sits. It's as a result of the revaluation, and it sits in the revaluation surplus account. So when you calculate, we are going to transfer that component, the difference in the depreciation charge, that excess depreciation, we are going to transfer it back to restate our retained earnings. But this whole thing is recorded in the statement of changes in equity. That's why you're going to see all these movements. Okay, so I think I've covered how you deal with the depreciation of revalued assets. So that is the journal entry there. Debit statement of profit or loss, depreciation charge, and then credit accumulated depreciation. And then after that, then you debit revaluation surplus and then credit retained earnings to transfer that depreciation charge. Then lastly, now let's deal with the disposal of a revalued non-current asset, or how we can recognize a revalued non-current asset. Okay. All right. So the profit or loss on disposal of a revalued non-current asset should be calculated as the difference between the net sales, the net sale proceed and the carrying amount. Okay. So the profit or loss, when you're disposing of an asset, you're going to say, okay, how much is the realizable value? How much are we going to sell this asset at? Okay. And what is the carrying amount of this particular asset, or the net book value of this particular asset? The difference that you are going to have. So if the market price, or the price that you sold the asset at, is actually higher than the carrying amount, then what we are saying is you have actually made a profit on disposal. Okay. But if the carrying amount, the selling price is lower than the carrying amount, then what we are saying is you've made a loss on the disposal of that particular asset. Okay, so there are two steps to disposing of a revalued asset. It should be accounted for in the statement of profit or loss of the period in which the disposal occurs. So when you dispose of an asset, you must actually account for it in the P&L in the particular year that you dispose that particular asset. So you are going to recognize that income in the P&L. Then the remainder of the revaluation surplus relating to this asset should now be transferred to retained earnings. So now that you've realized this cash, okay, so now you've got the leeway, or you've got the right to transfer the remainder of the the revaluation surplus pertaining to this particular asset back to the retained earnings, which are distributable reserves. So thank you very much. So this is this is how you actually deal with the revaluation surplus. So from the beginning, I think in part 1 and part 2, I've dealt more on the principles and the techniques that you must employ as you are actually dealing with IAS 16. But now, in the subsequent lecture, I think to be the last one, we are going to deal with examples. We're going to deal with questions. So the first question that we're going to deal with has to do with determining the cost of an asset, how we can determine the cost of an asset initially. So this question is coming from CA 2.1 2019 June exam, final exam. That's why I got that. And we're going to look at that in the next video. And then we are going to look at the subsequent expenditure question, a question that talks about the subsequent expenditure and how to treat it. We learned the theory and the principles. Now we must apply that in the next video. And then we are going to look at the practical question with regard to dismantling costs. So for dismantling costs, we are going to do 2 questions, this question and that other question there. So these questions have to do with dismantling costs. I'm going to answer this question in the next video. And then just some entries for reserve transfer that we just covered in the next video, and then we can actually call it finito. We can actually call it finito after we've done those questions. So next time that I'm going to do a video, I'm going to just concentrate on answering those questions. And then I think from there, you can go and try any question to do with IAS 16. And trust me, you're going to nail it as long as you paid attention to what I was talking about. I'm off, guys. I'm going to the next lecture. I'm having advanced taxation with my students at 19. So I need to, freshen up and just make sure that I've got a fresh mind to deal with the tax laws now. Thank you very much and good night.